In June 2013, the FASB issued a new accounting standards update that affects accounting for investment companies. My name is Erin Balog. I am a senior manager in KPMG's Department of Professional Practice, and this podcast covers ASU 2013-08, Investment Companies, amendments to the scope, measurement, and disclosure requirements. The headline for this ASU is that all entities except regulated investment companies and REITs must reassess the investment company accounting application requirements. The ASU specifically scopes in entities regulated under the Investment Company Act of 1940 and specifically scopes out real estate investment trusts. All other entities must reassess whether they possess specific fundamental required characteristics and to consider other typical but not required characteristics to determine whether investment company accounting and reporting applies. The ASU also clarifies the measurement guidance that applies to an investment company, and it requires new disclosures for investment companies. The ASU requires all entities to assess fundamental and typical characteristics in order to evaluate if the entity meets the definition of an investment company. All three of the characteristics listed on this slide must be present. The entity must obtain funds from investors to which it provides investment management services, and the entity's sole business purpose and activities should be investing in funds for capital appreciation, investment income, or both. These first two required characteristics are relatively straightforward, and they can be evaluated or supported by considering how the entity is presenting itself to its investors and investees. And one way specifically to support the entity's business purpose would be to review offering memos and structure documents such as the partnership agreement to evaluate how it is in fact presenting itself to its investors and investees and to support those first two fundamental characteristics. The last fundamental characteristic is that the entity doesn't derive any strategic or operating benefits from its investments other than capital appreciation or investment income. And this characteristic will require the entity to consider other relationships and activities that the entity being evaluated engages in. Examples of relationships and activities that are not consistent with investment companies are arrangements between the entity and the investee to jointly develop, produce, market, or provide products or services, an arrangement where an entity or its affiliates acquire, use, or exchange the assets, processes, or technology of an investee. Another arrangement would be where the investee provides financing guarantees or assets to serve as collateral for borrowing arrangements of the entity being evaluated. And lastly, when an affiliate of the entity holds an option to purchase ownership interest in an investee for an amount that is not equal to fair value. These activities I listed would generate benefits other than those related to capital appreciation and investment income and would lead to the last fundamental characteristic not being met. So after an entity goes through and evaluates all of the required fundamental characteristics and determines that each of these are present, the next piece of the assessment would be for the entity to consider the typical characteristics of an investment company. Tier 2 of the assessment is evaluating the typical characteristics. The typical characteristics presented on the slide are those that are usually present for investment companies, but if an entity is missing one or more of these, it can still be deemed an investment company. So judgment will need to be exercised when evaluating these. In order to demonstrate this, let's go through some of the common exceptions to typical characteristics that would not prevent an entity from concluding that the entity is an investment company. The first up is multiple investments. You could have a fund or an entity that recently commenced operations, which expects to have multiple investments in the future and is currently in a situation where it's only holding one and obviously not multiple investments, and that entity could still be concluded to be an investment company. Similarly, you could have a fund in liquidation that used to hold multiple investments, and due to the stage in its life cycle, it's now in a position where it only has one or two and not necessarily multiple, and that would also not preclude the entity from deeming itself as an investment company. Another common exception to the multiple investments characteristic would be a feeder entity, and a feeder entity could be part of the entire fund structure, but be in a situation where it's only holding one investment, and that investment being the investment in the master fund. And this fact pattern would also not preclude the entity from deeming itself an investment company. Another exception to multiple investments would be an entity between the fund and the fund's ultimate investment. Sometimes these are referred to as blockers. And lastly would be co-investment funds, which are sometimes called sidecars or side pockets. And what this is when you would have an entity, potentially an entity created to facilitate further investment from one of the existing investors, or a separate third-party entity that wants to come into and co-invest with the main fund into one of its specific investments. And in this case, an entity that only holds that one investment but is part of the greater fund structure would not preclude investment company accounting from being applied. The exceptions to the multiple investors characteristic are somewhat similar to the exceptions for multiple investments. The first exception to highlight would be a new fund that is in an active capital raise period and only has a few committed investors currently, but expects to have multiple investors in the future. A second exception to the multiple investors characteristic could be a co-investment entity whereby one of the investors in the main fund wishes to invest in one or more of the main fund's investments at a higher percentage than, say, they're committed into that main fund. If that one investor creates an entity to facilitate this add-on investment, and they are the only investor in this entity, this would not prevent them from concluding that the co-investment vehicle is an investment company. Lastly, there are structures in which a sovereign wealth fund or a pension fund creates an entity to facilitate its investment into a main fund that has multiple investors. This separate entity can be created for a variety of reasons. It could be tax-driven or to facilitate a separate management fee structure. But regardless of the reason, an entity created with the pension or the sovereign wealth fund as the sole investor into a larger fund would not prevent that entity from concluding it is an investment company. Next is the related party characteristic. It says that investors must include external or unrelated parties. And an exception here would be a circumstance in which there is an entity whose only investors are employees of the fund sponsor, and that entity in turn invests into a main fund. Because these investors are related parties, this fact would not in and of itself prevent the entity from concluding that it is an investment company. Other exceptions to the related party characteristic could be co-investment funds, feeders, and blocker entities, all of which we've previously discussed. The fact that they do not have or may not have unrelated parties as investors does not in and of itself prevent the entity from concluding it is an investment company. The fourth typical characteristic, ownership interests or equity or partnership interests, presents somewhat of a change from current guidance, which states that an investment company is an entity that has unit ownership in the form of shares or partnership interests to which proportionate ownership of the net assets can be allocated. This criterion was interpreted in industry as a strict requirement, and as such, many entities concluded that structured finance vehicles were scoped out of investment company guidance. Since unit ownership is now a typical and not required characteristic, entities in which the investors are lenders must be analyzed further and could present an exception to this typical characteristic. The last typical characteristic is that investments are managed on a fair value basis, and an exception to this characteristic could be entities whose investment strategy is to hold for yield or income. So as you can see, the typical characteristics allow for judgment and flexibility and require careful consideration. They're not meant to be viewed in isolation, but rather to be considered individually and in the aggregate in order to determine the entity status as an investment company or not. There really wasn't much of a change to measurement for investment companies as a result of ASU 2013-08. An investment company must continue to measure its investments at fair value as required by current U.S. GAAP. There's no change to the guidance about whether an investment company should consolidate another investment company in which it holds a controlling financial interest. Consolidation is permitted but not required, so you will see mixed practice on whether consolidation does occur between an investment company and another investment company subsidiary. The new guidance does clarify that an investment company should not apply the equity method to account for non-controlling investment interests in another investment company. These should be measured at fair value only, though it is usually acceptable to determine fair value of the investee entity using the net asset value per share as a practical expedient consistent with current U.S. GAAP. Lastly, there's no change to the requirement for a non-investment company parent of an investment company to retain the investment company's specialized accounting used in the parent's consolidated financial statements. This slide details the disclosure requirements included in the new ASU, and those include the following. An entity must include a statement that it is considered an investment company and it is subject to the investment company accounting and financial reporting requirements of U.S. GAAP. It also must disclose information about any change to the entity status as an investment company and the reasons for that change. And lastly, the type, amount, and reasons for any financial support provided to the entity's investees or financial support that is contractually required to be provided by the entity to its investees. So if after an entity goes through the two-tier assessment of fundamental and typical characteristics and it finds that it no longer qualifies as an investment company, it would apply the guidance retrospectively, and it would record a cumulative effect adjustment to retained earnings at the beginning of the period of adoption. Alternatively, if an entity determines as a result of the ASU it is now deemed to be an investment company, it should apply the guidance prospectively, and it would do this as an adjustment to its opening net assets. Lastly, we have the effective date on this slide, and this is for entities with fiscal years beginning after December 15th, 2013. What this means is for folks with calendar year ends, this is effective for 2014. This completes the podcast on ASU 2013-08. This session was intended to provide a summary of the new guidance, and if you're looking for more information on this topic or others, please visit the Financial Reporting Network page on www.kpmginstitutes.com. Thank you for listening, and I hope you have a great day.